If you had have asked me just before Brexit, I would have said the banks are at halftime. And they're basically waiting for the traction in the US economy to come through so interest rates can go up and you start to see organic earnings growth. So what's happened with Trump is he's, made people realise that yes, there's more prospect that the growth could be better, therefore interest rates are going up. So therefore people now accept the fact that we're in a period where banks can start to grow their earnings, and that's why they've reacted. So we're now firmly in the third quarter. Now the difficult part is the fact that he's also announced these proposed tax cuts, which the banks are the prime beneficiaries. Bank America, for example, would see its earnings increase 30%. So even though it's kind of run ahead on the basis of what might happen to interest rates and earnings, etc., and it's now selling on 12 times 2018, which is a fair valuation. If the tax cuts come through, it's back to 10 times. All of a sudden it's cheap again. So it could still be 20 to 30% mispriced. And if the economy keeps rolling along, it can grow its earnings, because we always underestimate, once we get into an up cycle, how much the earnings do. It could have 50% upside. So yeah, it's definitely in the third quarter, but where we are in that third quarter will depend on the tax cuts. If the tax cuts come through, the reality is we're at the start of the third quarter. If they don't, we're at the end of the third quarter. And the other issue that hasn't fully played out, and until it does, we believe the banks will continue to be a good investment, is the dividend story. The dividend story that started back post GFC, when dividends were basically zero because they were conserving capital. But once they restored their balance sheets, they could start paying out dividends, move to a full payout ratio like the Australian banks over a long period of time. That's really only starting to get on people's mind now. So again, until people value these banks reflective of their underlying 6 or 7% dividend yield, I think they'll continue to be a good investment. That's a hard one, I think, because Australian banks have been more fully valued. They've got earnings headwinds. They're going to struggle to grow their earnings, where the offshore banks have got a big recovery in earnings going through. So I think the biggest issue for Australian banks with higher rates will be the impact it has on its mortgage book. And what I mean by that is, I'm firmly of the belief that people are underestimating how leveraged that top 20 or 30% of home loan owners are. In other words, the guys that have bought more, say in the last 5 years, have borrowed as much as possible, and therefore there's no margin for error if interest rates back up. And on a worst case scenario, say interest rates go up a couple of hundred basis points, which most people wouldn't think is possible. But again, remember when I started my career, home loan rates were between 14 and 18%. We had one day where overnight cash rates were 100%. So the reality is 200 basis points in the context of what has happened over the last 30 years is not that an extreme event. It would be an extreme event though for 20 or 30% of mortgage holders. They would be under severe stress, and that would create enough of a downturn in property prices where the banks would have some issues to deal with. So I think in that scenario, higher rates, whereas they're positive for US banks and European banks because of where they are in their cycle, if the rates tick up too much globally, it's going to be a problem for Australian banks.